Silver has a different structure, but silver relative to gold is right now probably the biggest bargain in lifetime. If you go back 50 plus years and look at what silver price was compared to gold, it's at one of the lowest levels it's ever seen, and it has the technicals to reassert itself, meaning it ain't going to stay here. And it looks like it's about to. Now, when this occurs, if you go back in the prior major bull markets, you'll see that, especially in the latter year of the bull market trends, that's when silver especially exploded versus gold. Whereas during much of the bull trend, it was either on par with or underperforming gold in terms of the better place to be. But in that last year, silver suddenly goes berserk on a percentage basis. And we see that likely to occur now. I think it's going to be different this time. I've said this on a couple different interviews recently, is that while we go into an acceleration phase, which I think we're about to, especially noticeable in silver, but not so much in gold this time, that used to be associated with the final handful of quarters in the bull markets in 1980 and in 2010 and 11. Okay, so we say, well, that means we're going to top again. Well, this time, I think there's a different reality out there, both a macro, technical, and fundamental reality. And that is, this time, when we go through this next crisis of a given asset category, specifically especially the U.S. stock market, and also likely a potential crisis in the U.S. government bond market, that the outcome on the other end is not simply going to be, well, it simply priced itself down, stock market down enough to where it's cheap enough to go up again. There was a wipeout. This time, I think the consequence is going to be of monetary policy globally, where there is a shift in the world among central banks, which may or may not exist after this is over in terms of their acceptability, where we shift to real money. We shift back to gold, where, the currencies are not backed by nothing, but they're backed by gold. And I think that this crisis that we're about to face, which will be exhibited in the stock markets, especially in ours, and potentially in the bond market, will cause that kind of outcome, such that when the next time you get gold up to some high level where you think, oh, it's the top, it might be the top, but it doesn't necessarily mean it's coming down. I think it could just be a new reality where suddenly we shift out of fake money. How else do you define it? It used to be at least the dollar was backed in international transactions by gold, but Nixon even ended that. Roosevelt ended the domestic side. So you got nothing but pieces of paper that are hanging on my wall behind me there, and that's where they should be hanging. The reality, once the crisis hits, there'll be enough people, and there already are some in the academic world, that once the crisis hits, they'll say, listen, this hasn't been working. And it's not like this central bank game has been underway for centuries and centuries. It's been underway basically for a century. One very long human lifetime, we've had the Fed. And even some of that time, we had gold-backed currency. And now we have nothing but fiat around the world. Well, when that crisis hits and the real world effects of that error are exposed, there will be some folks, and maybe even the public, that recognize, what, I don't want this stuff in my wallet. Give me something stable I can count on its value. And there will be an upheaval, a revolution, if you want to call it that, in the monetary world, where we don't have from above definition and production of money.
All right, let's dive right into it. I've been tracking markets long enough to say with a fair degree of confidence that what we're seeing unfold right now, especially in silver, but also in gold and the broader hard asset sphere, is something none of us have truly experienced in our lifetimes. And that's not hyperbole. The signals are that loud. So let's start with the simplest way I can frame it. Silver relative to gold is probably the biggest mispricing of our lifetime, period. You roll the charts back 50 plus years, even 70 years, and you see immediately that this is not a normal ratio. It's screaming opportunity. And what's fascinating is it lines up with exactly what history teaches us about these long, secular commodity bull markets, particularly precious metals. See, silver often lags for a good chunk of the bull phase. People pile into gold first, either out of caution or because it's the most obvious monetary metal. It's where central banks go. It's where the headlines go. But in the late innings of these bull runs, silver explodes. Look at the late 1970s. For a long time, silver sort of plodded along. Then in the final year or so, it just went nuts. Ran from under $10 to $50 almost overnight, relatively speaking. Same thing happened in 2010 to 2011. Gold was steadily rising, sure, but silver was the one that popped from $17 to near $50 in a frenzy. Now here's where people get tripped up. They look at those last years of the bull cycle and they say, well, that must be the sign that it's over. This time, I don't think that's the case. And there are multiple reasons why. For starters, back in 1980, when we hit those crazy silver highs, Volcker was willing and politically able to jam interest rates up to 20%. That was his sledgehammer to crush inflation, defend the dollar, and reset the system. Can you imagine the Fed today hiking rates to 20% with $34 trillion in debt? It's laughable. They'd bankrupt the Treasury overnight. Debt service costs would be larger than defense spending times 3. So that option is off the table, meaning the next time silver and gold goes vertical, it's not going to be followed by the same kind of crushing policy response that tanked them in the early 80s. There is no policy tool left that doesn't involve just printing more money. And that brings us to the really big macro picture. What's different this time is that it's not simply a commodity boom, it's a global confidence crisis in fiat. You've got countries all over the world losing faith in the dollar system. You've got central banks buying gold at the fastest pace in 50 years. You've got emerging trade blocs, BRICS-SCO, openly talking about new settlement currencies tied to gold or baskets of commodities. This is the first time in modern history we're seeing serious efforts to dethrone the dollar, not just as a trading medium, but as a store of value anchor. And that changes the game entirely. Let's pepper in some recent news to underscore it. Last month, the European Central Bank actually published a statement in their Financial Stability Review where they said, and I'm paraphrasing, that the proliferation of gold derivatives was becoming a systemic counterparty risk. Think about that. The ECB is basically admitting that if too many players try to stand for physical delivery on these paper contracts, it could break the system. And you know what? They're right, because the COMEX gold and silver markets are fractional reserve systems. They operate on the assumption that 95 to 98% of contract holders will never actually take delivery. But lately, that assumption has started to break down. Since last November, we've seen record deliveries off the COMEX month after month. The May contract alone set new records. We're talking billions of dollars in gold and silver being yanked out of the warehouses. And these aren't mom-and-pop investors with a couple Eagle coins. This is institutional money. It's family offices, sovereign wealth funds, deep pockets who understand exactly what they're doing. I recently saw a breakdown from a respected analyst who said that since Easter alone, north of 35 metric tons of gold stood for delivery on COMEX. That's not contracts cash settled. That's physical metal, changing hands, moving out. You add silver into that mix and it gets even more absurd. In March, it was over 12,000 silver contracts. That's 60 million ounces. In May, new records again. And why are they doing it? Because sophisticated money knows we're late in the game. They'd rather deal with the inconvenience of arranging vault storage than trust paper promises that might not be honored when the dam finally breaks.
It's not so much on them as it's a secondary effect on them, because what should happen if that one key asset that people are only now recently noticing and a little nervous about, not panicked about, just nervous about, the T-bond market, not corporate debt, government debt, long-dated government debt, 10-year, 30-year. In stock market wobbles and tops, beginning of bear markets, which usually is hardly ever a sharp decline. It's usually an arm wrestling, deceitful sort of event where people aren't sure it's really top. It's just a correction, etc., like 2007 was. It wasn't until mid-2008 people finally realized, gosh, it's really over. But during each of these bear markets and stocks, even at the onset of, if you go back and look at two assets that did well, it's the stock market, it's the gold market and the T-bonds. They were alternative places to be. And this time they tried to do that. If you'll notice back in late March, early April, and we were frankly looking for a T-bond rally that might last a quarter or so as an alternative situation, meaning a rise in price, lower in yields. And it started, in fact, in early April, they shot T-bonds up from the 1-teens, 30-year futures I'm talking about, up to 122 on T-bond. Huge shot up, but within 2.5 days it crashed back to 111.5, where we're trading around now. Okay, why did T-bonds crash? They're an alternative. Gold didn't crash. Gold had a 5-6% drop and then immediately back up. It didn't make sense. I think what's going on is finally, after decades of knowing what you just talked about, that we've got a problem that can't be wished away, the government debt problem. And it's getting worse all the time, including under Trump now. We know the debt's going to be higher, and et cetera. Sooner or later, that reality will have a consequence, of in that market, the bigger asset market than the U.S. stock market, the U.S. government bond market. And if it does, that's almost beyond the control of the Fed to control. They influence the short end of the market. But when that long end of the market goes crazy and starts to pay the dues for decades of error, compounded error, what the hell's going to happen? I mean, both with government panic, public panic, interest rate wave effect in certain stock market sectors. For example, why does MSA pay so much attention not just to the tech stocks that everybody looks at, but to commercial real estate? RWR, VNQ, two big ETFs that express the commercial real estate market. Or watch the financial sector, because we know that the debt issue that's accumulated there ultimately will have to be paid. And I understand a lot of it's coming due in 2025 and 2026, commercial real estate. If it doesn't get paid, that means some financial institution on the other side of the equation is going to get gut kicked. And suddenly that's going to be a headline. So anyway, this is what's going on. And I think it's an ongoing process, and it will ongoingly help gold and silver and the miners.
Yeah.
And for some reason, this time, not the T-bonds, which narrows the field of the outperformers. Yeah, all the corrections that we've had, and there's a chorus of people on the internet, these free internet financial advisor types, who have called for a top in gold repeatedly and or a major correction in gold repeatedly over the last couple of years, especially since it woke up in 2024. In March of 2024, gold was back up to 2,000 for the fourth time. And we said, this time's different. It's going to explode. And it did. Silver did too. Silver was $25 then.
So let's really drill down into this, because what you've just heard me say about silver isn't merely a contrarian pep talk. It's embedded in decades of historical behavior and current structural evidence. And frankly, the setup this time might be the most pronounced of any in our lifetime. When you stretch the silver to gold ratio chart out over half a century, the picture jumps off the page. You'll see that historically, silver is vastly undervalued relative to gold right now. And that's saying something considering we're sitting near multi-decade price highs in nominal silver. The reality is, silver is a bargain for the ages when you look at it through that comparative lens. But let's get something straight. Silver does not simply track gold in a boring parallel dance. It acts like gold on steroids throughout major bull market periods, and this is consistent going all the way back to the late 1970s. Silver tends to underperform gold for long stretches, only to suddenly erupt in the latter phases of the move, outperforming dramatically on a percentage basis. That's precisely how you wind up with those wild blow-off tops like we saw in early 1980 and again in 2011. And yet, despite those historic episodes, I'm convinced that this time is fundamentally different. I know. That's the most dangerous phrase in investing. This time it's different. Usually it's used by people trying to justify paying absurd multiples for garbage growth stocks. But I'm not talking about chasing the NASDAQ in 2021. I'm talking about the structural monetary backdrop that now exists. A backdrop completely unlike anything we saw in 1980 or 2011. Back then, we had monetary crises, yes, but they were contained within systems that still had plausible long-term solvency. In 1980, the U.S. was grappling with inflation, but had nowhere near the debt-to-GDP levels we have today. In 2011, it was the aftermath of the GFC. We had monetary madness, sure, but there was still faith the Fed and ECB could backstop things. Now, we're staring at sovereign debt cliffs. It's the government bond market itself that's the next likely shoe to drop. And that changes everything. When the very instruments backing the fiat system start to break down, the consequences aren't cyclical, they're existential. That's why I've been telling people, yes, silver is likely to move with ferocity again, especially relative to gold, just as it did in the final phases of prior bull markets. But unlike past cycles, when we reach the next high, whatever that nominal figure turns out to be, it might not collapse back down. It could very well stick. Because at that point, it's not about speculative excess anymore. It's about the monetary system itself repricing everything. Let's spell this out. In the 1980 spike, once Volcker crushed inflation by hiking rates to the moon, gold and silver collapsed. The system righted itself temporarily. In 2011, Once the fears of the euro crisis subsided, it was more of the same. Metals fell, bonds regained strength. But what happens when the next crisis is literally about the solvency of the entire fiat structure? When the buyers of last resort, central banks, can no longer keep yields down without completely destroying their own currencies? That's the endgame we're creeping toward. It's why I keep saying, don't expect the next big surge to necessarily mean revert in the old sense. The top could be the new floor, and we're not the only ones seeing this. Over in the land of Twitter, or X if you want to be on brand, you've got guys like at Luke Groman posting charts showing U.S. interest expense overtaking defense spending, or at Tavi Costa highlighting that sovereign bond volatility has exceeded stock market volatility for the first time in decades. That's not normal. That's your system quietly telling you it's breaking. Meanwhile, look at what the gold and silver miners are telegraphing. If you chart the GDX or GDXJ relative to gold itself, you'll see a multi-year underperformance that's starting to flatten. Structurally, these spreads look primed to turn. Historically, when that happens, it often marks the acceleration phase for the entire precious metals complex. It means the leveraged plays, the miners, are about to catch a bid as investors finally rotate from passive bullion allocation to more aggressive equity bets. But the real structural bomb sits in the U.S. government bond market. As I noted in a recent interview, we're seeing peculiar price behaviors in the long end. Every time the T-bond futures dip toward key breakdown levels, say around 110, they mysteriously find a floor. Almost like there's an invisible hand. And no surprise, because there probably is. The Fed is intervening, directly or indirectly, to keep the Treasury market from imploding. And this is where things get sinister. Because monetary authorities can suppress volatility for a while, they can jawbone it or discreetly buy bonds via the back door. But they can't change reality. When your debt service costs become your largest budget item, eventually the market forces the issue. You either hyperinflate to pay it off, or you default. There's no magic third option. Now, if that sounds like doom porn, it isn't. It's just arithmetic. You can't compound debt forever at a faster pace than GDP growth without consequences. When those consequences finally hit, the world is going to have to pick new monetary bedrocks. And gold, with silver riding shotgun, is the obvious candidate. In fact, there are already serious intellectual efforts underway to prepare for this. You see papers floating out of BIS conferences talking about gold recollateralization scenarios. You have occasional ECB admissions that gold is a threat to financial stability, which is another way of saying it's the checkmate asset. And on the academic side, even mainstream economists are tiptoeing back toward the gold standard heresy. You have guys like Ken Rogoff grudgingly admitting that fiat systems tend to blow up under their own excess, though he'd of course prefer a central bank digital currency because, well, he's an academic and they love control. But the seeds are there. So let's swing back to silver, because silver is the wild card. It's the monetary metal with an industrial disguise. That means it has double demand levers. In times of monetary panic, it gets dragged up by gold. But it also has this supply chain vulnerability because industrial users panic too. They start stockpiling. That's why silver's upside tails are so violent. Think about it. We're sitting near 36 to 38 silver, pushing into multi-decade resistance levels after building a 45-year cup and handle base. You don't spend 4 decades constructing a technical pattern like that only to fizzle out. Once it clears, you're likely to see an upside eruption that will shock people. And it's not just price charts whispering this story. The physical flows are screaming it. In Shanghai, silver closed yesterday at over $38. That's several dollars higher than the NYMEX futures. This means the Chinese are effectively arbitraging the West, buying discounted silver in COMEX and selling it or redirecting it into Asia at a premium. It's precisely how they drained the London market over the past decade. Meanwhile, we've had the largest deliveries on record into COMEX silver. Tens of thousands of contracts recently stood for delivery, not cash. That's extremely important because it shows that big sophisticated players don't just want the casino chips. They want the actual metal. And once enough people do that, the entire leverage pyramid underpinning the paper price system collapses. It's like a game of musical chairs. The first few out the door get the medal, the rest are left holding empty promises. Now here's where I'll throw in a little humor to keep this from sounding too apocalyptic. I got an email from a subscriber the other day. He sent a meme with the caption, "When Comex defaults on physical delivery," and it showed a photo of Bugs Bunny dressed as a bank robber running out of a vault with bags of gold. It's funny, until you realize that's probably not far from how it'll look in financial headlines one day. So to wrap this up, here's my honest forecast. We're on the cusp of a monetary regime change. The next big shock isn't going to be a normal recession. It's going to be a structural crisis that reorders the entire hierarchy of money. When that happens, don't expect gold and silver to behave like they did in past cycles. Don't expect them to peak and crash. Expect them to reset to radically higher levels and stay there. Because the world will have to anchor its confidence somewhere. And when that happens, you'll be glad you didn't get shaken out by short-term volatility. So keep your eye on silver. It's about to do things that will look irrational to the unprepared. But to anyone who studied monetary history, it'll make perfect sense. This is what endgames look like. This is how trust is rebuilt. Not with new promises from the same failed institutions, but with timeless money that needs no promises at all.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.